friends. Welcome back to the Wall Street Skinny. I'm Jen.
I'm Kristen.
And we are two lifelong friends with a combined 25 years of experience working and teaching on Wall Street, here to give you the skinny on the world's highest paying jobs and explain how the world of high finance actually works. And the genesis of today's episode is that we get so many questions from our social media community about private equity. And we had a couple of people on social media regularly asking, when are you going to do an episode on PE secondaries? And we were like, yeah, PE secondaries, like any day now. Like, P.S., what the hell is a PE secondary? Well, we were fortunate enough to have a young man on Instagram who was one of those voices connect us with his mentor named Justin Resnick, who is a managing director in Evercore's private capital advisory group, specializing in, you guessed it, private equity secondaries. So we are here today to share all of his insight into one of the fastest growing and I think least understood segments of the private equity world. I mean, Kristen, had you ever heard of secondaries before we started this whole thing?
No. And again, the irony is that when I was working at Morgan Stanley, I was working in the financial sponsors group. And obviously that was focused on leverage buyouts and IPOs and doing all the things that private equity firms needed to do and need an investment bank to help. I don't believe that like this whole secondaries thing had even started when I was there. I mean, it could have been like a little thing.
It definitely was in existence. And one of the things we're going to get into with Justin is the evolution of this sector of the market, of how it evolved with kind of one specific set of purposes and filling one need from investors, both LPs and GPs, limited partners and general partners, and then has now taken on a whole life of its own, which has been the driver of so much investment into the segment.
But again, we never did anything with it. It wasn't a conversation at the time. And it was happening. It was a very small segment of the industry. And it's become now more and more and more. And I think Justin gives us some hard numbers on just how much capital is going into the space. But again, back in like when in 2010, it was not part of the,
it wasn't part of the conversation. And now it's very much at the forefront of the conversation in the private investment sector. But before we get into that, I don't know how many of you guys are Bravo fans out there, but I am so excited for part 2 of the Summer House reunion. Have you watched it yet?
No, we tried actually last night, but our internet is so bad. So it's
really terrible. As an outside observer, I can confirm it's terrible.
I don't know what's going on. So we ended up, I said this to you last week. We've been rewatching Suits. So we decided to do that. For whatever reason, Netflix was fine, but our DVR was absolute garbage. So
I love that you still have a DVR. I think you're like the last DVR customer in America.
Well, I blame John because he likes to watch his golf and all that kind of fun stuff. So I think he DVRs games and then wants to watch. I'm sure there's a better way to do that.
We do YouTube TV. Yeah. So you can schedule which programs, because we don't have cable. We've cut the cord entirely on cable. And I think probably between all the streaming subscriptions we pay for, we probably pay more at the end of the day.
Oh, but we pay for streaming too. I was an early anti-cable person in 2010.
Wait, no. Tell the story. When you first lived in New York City, did you even have a TV?
No, I was like, why do I need it? I can watch on my phone. I would watch on my computer. I was doing what people now do in like 2007.
Yes.
Actually, no, when I was in college.
Of cord cutting and because you were so cheap.
And I was cheap, but I also said to John, I was like, why the heck do we need it? Again, he wanted it for sports. And I think now it's like, he's not ready to let go of cable. But no, the only reason that we have it is because of him. But if it were up to me, I never would have gotten it. And by the way, I would prefer to watch my stupid shows on like this tiny little device versus watching on.
Well, you don't need Andy Cohen in, 65-inch screen surround sound. It's right. Like the things that you and I tend to gravitate towards on TV don't require like an immersive Sonos experience.
Well, that's not true. You have gotten me into, again, just like really great TV shows. Shogun, I do think you benefited from having the larger TV experience.
That's true.
I mean, look, like I recently wrapped up watching Hacks, which is not like
I can't wait to start that.
I
heard that's good. Yeah, I'm excited for that one. It is
so good. I love that show. It is so funny and just smart, and I'm obsessed. I can't wait to talk to you about that. But so anyway, long story short, our internet sucks. I tried to watch Summer House, but I am very excited to watch the second installment. But we talked about how with Wes, he was like the darling for the season. And I mean, he basically, it's like,
what a fall from grace.
What a 180. what a 180. For people who don't know, he was this where was he from? Like a Wisconsin? Minnesota. He's from Minnesota. His like
Football
mom
player.
is an OB. His dad was
Cattle rancher.
like a cattle rancher.
Yeah.
And he was not attractive at all. Comes in the house, is funny, and somehow gets
not
Sierra.
conventionally attractive, I'd say.
He's not. No,
I was seeing his old football
weirdo?
Pictures. I was like, oh, I can see it. But compared to, I mean,
his hair,
my darling
his
Jesse
hair.
Solomon.
But his hair in the show. So he ends up somehow getting Sierra, who is supermodel level gorgeous. I didn't like her that much in the earlier seasons because I felt like she was a mean girl with Paige. But then she was so nice with him. And like, I was like, I love you again. And beautiful, like drop dead fucking beautiful. I'm like, how are you into this guy? And then she wanted to
funny.
Because he was funny. He's like, and then somehow,
which makes me like her more for liking the guy who's not conventionally attractive, but it's
what we
funny.
were talking. Yeah, which is what we were talking about with Zendaya too.
Yeah.
And then in the reunion, they get into why they're not together, and she wanted a relationship, and he was like, just not.
But here's the wild thing about it: he didn't want a relationship because he wanted to be able to go to all the Bravo events with the female viewer base and be unattached and not worried about cheating on her or whatever. And the irony is he was beloved by the fans because of how nice to her he was, what a gentle guy he seemed like a funny, sweet, endearing guy. And that audience, I think, has completely turned on him from one second to the next. And he achieved the exact opposite of his intent and is now the villain in the story because he wanted to preserve his optionality. It's like, well, I'm sorry, you were going to do better than Sierra ever in your entire
life. Well, it's also no one.
No.
Again, she is just so perfect because she also was like a nurse and like was just like
and in her spare time is saving lives. Like while
it was like a nurse.
Gorgeous. Like that's not allowed.
Yeah. And then I felt like Paige kind of corrupted her a little bit, which I didn't, again, I like Paige, but she is her. And then it was like Hannah Berner. They were such corrupting influences.
I don't care for Hannah Berner, but I think Paige is hilarious.
She is, but she's got that mean girl streak. And I don't like that. I do think she has a little bit of, I don't know. I think if I was in a group with her, she would turn on me.
She wouldn't like us. No, she
she would not. We're not.
She would not like us. She wouldn't let us sit at her table.
No. I enjoy watching her on TV, but then in a fight, I'm never on her side because I'm like, you are the bad guy. But anyway, so the whole moral of the story here was that Sierra, freaking beautiful, cool, smart, does good things like saves people lives in her spare time, and then somehow this doofus rejects her.
Doofus is a great word. Okay, so let's circle back to our topic of the day because there's one other element of this conversation that I do want to touch on just briefly. Justin graduated from Emory, which is a phenomenal school, very well regarded, but not one of the absolute small short list of hyper-target schools. It's kind of I'd call it like a semi-target, if you would. Is that a fair assessment?
Yeah, well, actually, I think we're going to get pushback on this. It's funny because the term target and semi-target has become so, I don't want to say polarizing, but it's, I saw a post where they called Brown a semi-target, and I was like, excuse me? But we also had done a thing.
Like every single senior person we've had on this show has been a Brown grad.
I mean, they've fallen in the ranks from the U.S. News and Ranking System, but
who cares about U.S. News and World Report when it comes to your Wall Street alums?
Well, I actually was talking to John about this last night because we're watching Suits, and we were talking because Rachel just got accepted to Stanford and to Columbia, and John was like, "Well, where does Stanford rank?" And so he was looking it up, and he's like, "Oh, weird," because I think that, and I forget if it was business school or law schools. We were looking up the rankings. Harvard was like number 4. And there was just some surprising names in there. And I was
for
like,
business or
at the end of the day, I forget now. But the point is that when you're going to a school, it's the brand and the alumni network. And so the rankings to me are kind of irrelevant. It's like buying a Chanel bag or an Hermes or a Cartier watch. It's not, it has nothing to do with where the rankings fall. It's what is the brand value.
You're 100% right about the brand name, and the brand name when it comes to recruiting opportunities may be wildly different from the brand name when it comes to what are the best schools to apply to out of college. Those two may be totally divergent, right?
And it's also based on the alumni and where those alumni are working now, which is another huge factor. in
So
the recruiting
being a
opportunities.
target, you could be a target school and be ranked 25th in U.S. News and World
60th.
Reports.
Brentfield is 60th.
There you go.
Like, what are you doing over there? But yeah.
So the two are totally divergent. But when you and I were coming into the industry, I don't think Emory was considered a premier target school. I think it would have been considered more of a semi-target school.
Right.
And I think now one of the things that we get into is the strength of the alumni population and their dedication to elevating the school's profile on the street has turned Emory into more of a target school. And it just goes to show that that list of target schools, quote unquote, not only is that always in flux based on the position and involvement of alumni wherever they have gone on the street and elsewhere, but people's attitudes towards recruiting from those target schools are also constantly in flux. So I think that that's something that is always happening in real time. And the idea that there are these fixed parameters around what's a target school, what's a semi-target school, the same way we think about rankings for anything, I think that's a flawed misconception from a lot of young candidates coming up through the system, whether it be coming from high school, applying to college, or in college, thinking about where they rank. So just know that your school's position and you as a target or non-target, that's not something that's set in stone and can continually be worked with. And let that be a message too to all of the alums who have come up through the system and gone out into the world and are now successful. How do you want to give back to the young people coming up through the institution that got you where you are? So something to be thoughtful about.
Yeah. And I mean, look, we've had conversations with some very senior thought leaders who have said that some of the schools that they are actively going to recruit are changing because they're just seeing better candidates from certain places. And one of those names that came up, I think it was Babson, which is funny because that's where my dad did his night school. So my dad went to business school at Babson. It took him, 10 years however long he did night school, like the executive MBA program. And at the time, like Babson, it was always known for its business school, whatever, but it wasn't that impressive. And I do think that is a school that is starting to get recognized for having good candidates and, teaching people well and producing high quality candidates. So to your point, I think, as you said, the list of schools that are quote unquote target can change, can shift. And it's not necessarily hard and fast that it's always going to be this school. Brand values can change. Youngins, be aware.
Yes, that's exactly right. So, okay, I think without further ado, let's bring Justin on and take it from there.
Yay.
So Justin, I'd love it if you could quickly walk us through your bio, talk to us about how you got started in the industry and what you do now for Evercore, what your role is and what your business line looks like.
Sure. Yeah, happy to. And thanks for having me. So again, as you mentioned, Justin Resnick, Managing Director in Evercore's Private Capital Advisory team. Been here almost 3 years, but have been doing secondaries for over a decade, which makes me feel and sound quite old, but I'm not. And
to the club.
It's been a roller coaster ride. It's been when I joined the industry basically 10 plus years ago, it was a small dark corner of the private markets. We'll go there and I'll give you a little bit of a history lesson, but just by way of background, originally from Long Island, went to school down at Emory in Atlanta. So finance and accounting major there in the undergraduate business school, was also on the basketball team all 4 years, captain of the basketball team. So that was a great experience. In school, I knew I wanted to do something in business and finance, but didn't know what it was. And so throughout the internship experience and exploration process, did everything from, corporate finance to private wealth management to sales and trading. And through each of those experiences, just try to pick certain things that I liked, certain things that I didn't like, and try to figure out what job I actually wanted to do after school. My first job out of school was at Citi. I worked in their energy group actually down in Houston. But very shortly thereafter, all my friends, all my family was in New York. And I'd also wanted to work at a little bit smaller of a bank, coming from Citi, big bulge bracket bank at the time was 165,000 employees. That was where I started to figure out what I wanted to do next. And I liked energy. Oil was $100 a barrel at the time. It was the hot spot to be in, a ton of M&A, a ton of stuff going on, but didn't know that I wanted to do it forever. And so started to explore other things and found this small little group. It was 5 or so people at Houlihan Lokey called Secondaries Advisory. And thought that it was an interesting blend of M&A with a new part of a market that was growing, and I could be young and get a bunch of responsibility. Joined that group at Houlihan, was there for the better part of a decade before making the jump over to Evercore 3 years ago.
Cool. Nice. One just really quick question, because we actually get a lot of people who ask, how was recruiting out of Emory? Literally, we've had multiple students in the last couple of days ask us about Emory recruiting. And Emory obviously is super fantastic school. Do they have a heavy recruiting presence there or not? Like the different banks?
Yeah, so I think that's the good news, that it's changed a lot over time. When I was there, we had to work really hard just to get our foot in the door. I think the good news is that as folks like myself and others before me have been successful, they know the quality of that talent there. And so we're the first ones to raise our hand and actually be super active in the recruiting process, which I still am today.
So let's jump to PE secondaries. It's something that I think very few people are familiar with. Can you explain what PE secondaries are? Literally talking to us like we are 5. I know you have young kids. I know you get it. If you were going to explain it to one of your young children, how would you explain it?
Yeah. So when I started in the industry, kind of 2012, 2013 type timeframe, market was probably $20-30 billion of volume. And so today we're $120, $130 billion plus that we expect to do this year. So how do we get from there, where I started, and maybe even I'll rewind a little bit before that, to where we are today? And so basically the 101 is this. If you compare public markets investing, right, you can go through your Schwab account, you can buy and sell stocks, right? That's a public market. It's highly liquid for the most part, right? In the private markets, private equity funds, for example, which is most of what we do, those are locked up vehicles. They are fund commitments in a commingled vehicle. That's a 10-year vehicle, typically, with some extensions on the back, right? So you commit to invest a certain amount of money, and that GP, that sponsor, that private equity sponsor, has the right to go and invest it over a few years to grow that portfolio, and then eventually you expect your money back.
Pause for just a second. When you say you invest your money, you mean LPs, you mean institutional investors, the pension funds of the world, the endowments of the world, et cetera, right? That's who we're talking about as being the investors in these vehicles?
The overwhelming majority of that capital, just given the treasure trove that they have and the quantity of capital they have, yes. That said, there are plenty of high net worth individuals that get invested in these funds, but there's generally some type of a minimum, and we won't probably spend much time on today, this whole retail push of your individual investor investing in funds through various types of 40s Act funds. That's a big push for the market. There's plenty of press on Blackstone and others raising boatloads of money through the private wealth channel through retail money. But yes, the majority of the capital are pension funds, sovereign wealth funds, endowments, foundations, big pools of capital investing hundreds of millions, if not billions and billions of dollars a year.
Yeah. Okay. And so you talked about the sizing of the market, but what exactly is a PE secondary investment versus the traditional private equity model that we've talked about before? Kristen always uses the example of the traditional LBO model, like buying a house financed with a hefty mortgage. What are we talking about here when we talk about PE secondaries?
So the investors that you were just mentioning are invested in funds that are doing the LBO deals that Kristen's talking about. And so in any given fund, there's 5, 10, 15 different deals. But again, that commitment is a locked up longer term commitment. And so if you go back, the first secondary funds were started in the kind of mid 80s or so, but the market really started to take off when you think about the bursting of the dot-com bubble. And so what's happened in times of crisis or things like that, you've seen various investor types that need liquidity. So you have a ton of money that's locked up in this vehicle that is otherwise an illiquid investment, but you want out, right? You need to go invest in something else. Your mix of private versus public investments is totally out of whack versus your target. And so what's happened is there's been these pockets of capital that have been formed to say, I'll buy that, right? I'll step into your shoes as the investor in that fund and ride it out, right? So for a price, I'll buy that exposure from you. I will step in. You will transfer that LP, that limited partner interest in the fund to me as the secondary investor. And that price may be 100 cents on the dollar for what the GP thinks it's worth. It may be 75 cents on the dollar. It might be 110%, right? So it could be somewhere in between depending on the underlying assets and the outlook. And so in these times of crisis, whether it's dot-com bubble, you have great financial crisis, those types of events have created step function changes in growth for the secondary market because there's a ton of opportunity. There's a lack of liquidity that's out there, and they can come in and solve that problem. So the market started on the LP side, buying LP portfolios, so limited partnership portfolios of private equity interests in funds. And that's where a ton of the capital historically has been raised and come into the market. Now, over time, that capital base has grown. And so what have you seen? You've seen specialization of that capital. You've seen increasing scale of that capital that's looking to be more and more creative to find various opportunities to deploy that money and invest that money. What that's led to is the LP market expanding into what we now call the GP-led market, the general partner-led market, which is the private equity sponsor leading a transaction that provides that liquidity, as opposed to the pension fund raising their hand and trying to find a buyer and say, I want someone to buy my LP interest.
So Blackstone, for example, has a fund and they want to allow some of their LPs, like their LPs say, hey, we need liquidity. You know, I know it's a 10-year lockup, but it's on year 2 or 3 and we need some cash back. So the GP then says, okay, Blackstone says, we're going to now do some sort of secondary liquidity event. So we're going to go out and raise money and then we'll buy out the stakes of these different LPs who want to cash out. Is that kind of the right way to think about it?
So yeah, that would be, if you're providing liquidity to all of the LPs across the entire fund, that's what we would call a tender process, right? So Blackstone would hire an advisor to typically go out and find buyers to price the fund and offer that price to their LPs. And you would go through with a pretty strict 10, 20 business day tender process where the LPs can say, okay, I like that price. I want to sell. I don't want to do anything. Leave me alone. Right. And that would be a tender process where the LPs could sell their LP interest to the secondary investor. Another form of a GP-led transaction is what's now known as the continuation fund, right? Back in the day, it was a fund restructuring. There were all different types of terms for it. Now it's known as a continuation fund, and this has become 50% plus of the overall market.
Yeah, I feel like I hear that all the time and don't know what it means.
And so that is where the GP, the sponsor, is looking to create a liquidity event, but generally around one or more specific assets within their fund, or it could be across multiple funds. And so we'll take a single asset continuation fund to just simplify it. You have a sponsor that owns an asset. Generally, the single asset continuation funds are kind of your crown jewel asset, your best asset. You've owned it for 3, 4, 5 years. It's crushing it, right? It's 3 times your money. You tripled the size of the business. You quadrupled the size of the business, whether it's organically through acquisitions. They've just done incredibly well. Well, without the secondary market, what would the sponsor do? They would say, well, this is a huge winner. I want to crystallize that return. I want to put points on the board. I want to send my money back to my investors because my ability to raise money going forward is based on my track record. And so having an early winner that's off the charts crystallizes a really great IRR, usually a really good MOIC. So on average, single asset continuation
Wait,
fund,
sorry, what was MOSC?
MOIC.
sorry, multiple invested capital.
Oh, okay, got it. Thank you.
So I've made 3 times my money. So historically, what the GP, what the sponsor would have done is, I'm just going to sell it. Well, who do they sell to? Maybe they sell to another sponsor. That other sponsor is going to pick up right where they left off, same value creation plan many times, and they may make another 3 times their money, 4 times their money, 5 times their money. So with this technology, that sponsor can now provide a liquidity option to their existing investors while retaining the ownership. And so what we do is, similar to the tender, we go out and we run what looks like an M&A auction process to a specific set of secondary investors. Those secondary investors are going to provide a price. They're going to underwrite the asset just like the private equity sponsor would and say, I'm willing to pay X. That existing GP can take that offer back to their LPs. Do you want to sell and you can crystallize your 3 times return? Or do you want to stay in? We're going to move this asset to a continuation fund, basically a special purpose vehicle or an SPV that's set up to own this company, to buy the company out of the existing fund. That SPV is capitalized. The money behind it is the secondary investors, the existing investors that want to stay invested, and the sponsor, right? Because the sponsor generally will invest in their own funds. And they will roll that interest into the continuation fund.
So just to be clear, if your entire investor base is 10 LPs, just to make it simple, and 2 of them want to take their cash now, the secondaries come in, the cash goes to those 2, and the remaining 8 would basically like roll their interest into the new fund and
Exactly.
with the new secondary investors.
That's right. And the reason the technology works, right, is because this is purely an LP option.
Mm-hmm.
Remember, as we said before, this is a 10-year investment.
Mhm.
You get a capital call, you invest your capital as the sponsor asks you to, and then you get your money back later. You don't have individual say over specific buying and selling options. Here, you actually have an option, right? And so that is why this is kind of a win-win scenario, because your LP is given an option. They don't have to do anything, or they can sell, right? They can sell and say, thank you very much. I'm going to go and buy a boat. I'm going to go and invest in a new fund. They can do it.
Got it.
Okay, so a couple of questions. It sounds like this technology evolved from being a kind of emergency liquidity provision in times of weakness to now an opportunity for people to take out liquidity in times of strength and be able to roll things forward in a way that they otherwise wouldn't be able to, while still, like you said, putting numbers up on the board. Are they saying, hey, listen, we have this secondaries option to consider. This is going to be something that's going to come into play if we hit XYZ bogeys? Like, when does this conversation happen? Does it happen from the initial investment? Does it suddenly come up as a surprise, things are going well, or surprise, things are going badly conversation? How does that nitty gritty work?
Yeah, so the first point about the evolution of the market and the use case here is definitely true, right? If you go back to when I started my career, we were doing deals on generally funds that were at the end of their fund life that had done just okay or maybe not so great. And the sponsor, because of that performance or lack thereof, they would probably have trouble raising a new fund. But they own assets today that they think have value and have upside. So what we would do is we would cycle out the investors, similar to what we just spoke about, and say, okay, you have 3 companies left. We're going to bring in new investors, offer you a liquidity option, give the sponsor a new lease on life, reset their economics. So hopefully they're incentivized to continue to manage the assets and maximize value. And so that was like the fund restructuring days where you would restructure the existing fund, move the assets to an SPV. Same idea, right? But now that's being applied to these crown jewel assets that need more time, that need more capital, that do really well. We still do end of fund life stuff as well, but it's a smaller portion.
End of fund life care. Yeah, we put them in hospice.
Well, that's what it is, right? Think about it, right? We've spoken about this, but it's a 10-year fund. So when you're in 8, 9, 10, 11, 12, your investors want their capital back. But maybe it's not the best time to sell those assets. You don't want to fire sell those assets.
Yeah.
And so this offers that option. End of fund life is not necessarily a bad thing anymore.
It just sounds so funny. I love it.
So yes, the transition or the migration to these super high quality assets, super high quality sponsors, really great track record, that has definitely happened over time. Now, the fund docs for a fund that's 6, 7, 8, 9, 10 years old isn't necessarily going to have this continuation fund concept pre-wired into it. Okay. And so because the sponsor is going to continue to manage the asset going forward, but they're also selling the asset out of the existing fund, there's a conflict of interest there because they're buying and selling. And so that's why communication with the underlying LPs, there's a consent process. We need LPAC, which is the Limited Partnership Advisory Committee that's set up for each of these funds to clear that conflict and say, we understand you ran a fair process, you hired an advisor, there's a fairness opinion, this is a quote unquote fair price, right? Like all those things allow it to happen. But LPs, the investors in these funds, have come a long way too, right? Because it is a conflict transaction. Many of them have mixed views on them. That said, it's improved pretty dramatically over time, especially when you think about the liquidity environment we're in today. So if you think about the last 12, 18 months, M&A market's down 20+%. Last year, we had 12+% of private equity exits happen through continuation funds. That has changed pretty drastically. If you're an endowment or a pension fund, you're a limited partner in private equity, the distributions, the returns coming out of those vehicles was quite low because M&A volume is down. Rates are high. Sponsor-to-sponsor volume goes down because the debt market dries up. All these things impact M&A volume. And so if you don't have the cash coming out of your private equity portfolio, how do you go and continue to invest in new funds? And so this continuation fund product allowed them to receive a lot more liquidity and crystallize really good returns that they would not have otherwise had. And so we've seen a pretty drastic shift in LP opinion, LP behavior. So in our processes, over the last 12, 18, 24 months, you see, again, LPs have an option, you get a price, they have an option to sell. 80, 90, 95, 99% of LPs in these processes elect to sell and take that liquidity.
So quick question, who are some of the main players in the secondary space? Is it other private equity firms? Do LPs, so say like the pension funds, have almost like buckets of, because we've talked in the past about kind of like how these allocators actually allocate their capital. And it's like, this amount is to equities and this amount is to fixed income and this amount is to private equity and this amount is to hedge funds. Like, is there a bucket for secondaries? Who are the main players and where is this cash coming from?
Yeah, so that is another thing that has changed dramatically over time. Mm-hmm. I'll caveat that by saying that we're still in a pretty drastically undercapitalized market, right? So if you look at, our firm does a survey at the end of every year and talks to all the big investors, how much dry powder do you have that you can invest going forward? Yep. We had dry powder at the end of last year at $166 billion. Mm-hmm. But think about that compared to the transaction volumes that we were talking about, $100+ billion transaction volume. Yep. So at any given time, this market has enough dry powder, enough capital to do 1 to 2 years worth of deals. Mm-hmm. You compare that to the private equity world, it's significantly higher, right? Multiples higher. So we are still an undercapitalized market. That is changing though. So historically, even today, there's probably only 15 to 25 really large secondary players that can underwrite, can write a really big check, multi-$100 million check. And some of these funds are some of the largest private equity funds generally out there globally. So
think of like your classic names.
Dedicated secondary teams, but you're seeing more of the classic names come in. So I'll give you a couple examples, right? Okay. Blackstone has strategic partners, right? Blackstone Strategic Partners has a $25 billion or so secondaries fund that does both LP deals that we spoke about at the beginning and GPA deals. You have groups like Ardian, right? 25, they probably get to something close to $30 billion. Lexington, 23. But you go down the list and there's billions and billions of dollars, but again, they're split between LP and GP for the most part. There's fewer, but a growing list of dedicated GP-led deals to do those single company or even 3, 4, 5 companies at a single time versus the private equity portfolio of limited partnership interests.
And sorry, really quickly, when you say the LP led, would that be like one of the LPs just needs cash and they want to just sell out their stake, so they kind of go look for someone on their own to try to sell?
And that gets done on a single fund basis, but more generally, it's a pension fund that says, I need to generate $1 billion of liquidity. Yeah, I'm going to put these 100 fund interests out for sale, right? And that could be equity funds, that could be growth equity funds, that could be venture funds, credit funds, right? So that's part of the change in this market on the capital side, is that you've seen what has historically and continues to be a very buyout private equity LBO oriented market expand and specialize into growth equity, venture capital, credit, infrastructure, real estate. So that's probably a conversation for another time, but that is happening and has happened in a material way. But to your point on the sponsor universe, right, you have relatively new entrants like Apollo. Apollo's in the business. TPG is now in the business. You're seeing Audax get in the business. Leonard Green recently announced that they're getting into the business. So the list goes on. This is becoming an increasingly interesting area that buyout LBO type sponsors are even looking at it and saying, well, if most of my deal flow comes from other sponsors and those sponsors are going to do these continuation funds and not sell their companies outright, at least for some extended period of time, then how am I going to get my own investors access to those best of breed companies? I'm going to start a secondary franchise and partner with other sponsors, which is a little bit unique, although co-control type deals are common. So it's a new world, right? So the pool is increasingly growing.
This is so fascinating because, again, I'm just going to kind of bring it back to some of like the 101s, which is if you're a private equity firm, you buy a business and then you hold it for 5 to 7 years and then you sell. Well, guess what? You're normally selling it right to a strategic or to a private equity firm. And now the private equity firms, now you don't have the actual access to get those new companies. There's now a lack of companies that you can actually invest in. The universe of ideal targets is only so wide because you have to have like the cash flows, you have to have the right price, right? You have to have banks be willing to lend. So this makes so much sense that now it's an evolution because of some of the things that are changing in the structure of the market. Anyways,
Yeah,
this is so
and
fascinating.
think about the companies that we're talking about. For the most part, these crown jewel type assets. So you have really great sponsors with their best assets. And so even if you're investing in a continuation fund and you're by definition paying that sponsor economics, you're paying management fees, right, to manage the asset, and you're paying carried interest, which is a percentage of the profits, right, to incentivize the sponsor. On a relative basis, that is still really attractive risk-adjusted return. So we sponsored a study that actually went out and started to look at continuation fund performance.
Yeah, that was going to be my question.
It's a new market. And so the realized performance of continuation fund assets actually being sold is fairly limited, but you know where those assets are marked over time, you know how they're performing. And so we basically had a professor go out and on a blinded basis, we couldn't see it, get all this continuation fund performance data. Interestingly, what you saw, which again will make sense based on the thesis, is that there's a narrower dispersion of outcomes for continuation funds. So what you'll see in our data, or Hamilton Lane, another big secondary investor, does a bunch of really good research on this that's publicly available. The winners continue to win. Winners that a GP, the sponsor, is highly motivated to continue to have win, and they're highly aligned, right? That is one of the critical pieces of these transactions, is the GP is taking all of their economics and rolling them into the continuation fund. So their actual ownership of the company on a look-through basis goes up in these transactions. And so the alignment is key, because all the secondary investors are passive investors. They're backing the private equity sponsors, and so they want the private equity sponsor to kind of put their money where their mouth is. And the way that they do that is by rolling all their economics into the deal. So you have great sponsor, great assets, great alignment. Generally, it's probably not surprising to hear that the range of outcomes, the fan of outcomes, is going to be narrower. And that's starting to prove itself out in the numbers.
Got it. So quick question, how does the pricing, like the fees that the private equity firms charge with these continuation funds work? Is it the same 2 and 20, or is it higher because these are their crown jewel assets? How does that work?
Yeah, so interesting question. And this is a little bit of like a secondary market mechanic, but generally the management fee on an absolute value, on a percentage basis, is actually lower. But, so think about it somewhere in the range of 50 to 100, 125 basis points on the high end versus the 2%.
Yep.
Why?
But, well, so think about this. You've made 4 times your money on this company already.
Yeah.
So if you invested 100, it's now worth 400, and you sell it at 400 to the continuation fund.
Yep.
If you were charging 2% on the 100, now you're charging 2% on the 400. You're still managing the same company. Should you, as the sponsor, make that much more money just on the management fee alone? And the secondary market's view is, no, you shouldn't. Right? So the management fee is not necessarily, it's usually neutral to slightly accretive, but because the alignment is so important, this is not a trade where you're going for a management fee grab and you, as the sponsor, are going to make a ton of money on your management fee.
Got it.
What you are going to make a bunch of money on is you, by selling the company, any of your LPs, any of your investors that decide to sell, if you've made 4 times your money on the company based on that price, there's carried interest. So the sponsor gets a portion of the 4 times your money of those profits. They roll that interest into the continuation fund. It continues to compound, and the sponsor gets new carried interest on the continuation fund. Right? So it is accretive to the sponsor in almost all scenarios. It's great for the LPs too, right? Because they have this liquidity option and they can stay invested.
Okay.
So that's
That is so
the management fee side, right, is usually a lower optical number, but the dollars end up being the same, if not slightly better.
I was like, there's no free lunches in this. Like, what's the real deal?
Just to finish it off on the carried interest side, right, because the GP economics are management fee and carried interest, a percentage of the profits. The way the secondary market likes to structure these, again, going to the alignment point, is it's actually a tiered waterfall most of the time. So instead of 20% of the profits over an 8% preferred hurdle, generally there's 2 or 3 different tiers. For example, you only get 10% carry over the 8% hurdle. Okay. But if you make a 15% IRR, you can get 15% carry. And usually it's IRR and multiple of money based. So call it 10% over 8% IRR, 15% carry over 15% IRR and 1.5 or so times multiple, and 20% over 20% IRR and 2 times your money. And there's variations of all of that, right? Sometimes it's 15, 20, 25. There are examples where it's just 20% over 8, but most of the market is that 10, 15, 20, with the idea being we're even more aligned. If you just do okay as the sponsor, you're going to get less carry.
This is fascinating.
Can we pivot a little bit and talk now about what the role is of someone at an investment bank doing this advisory and doing these fairness opinions and valuing these companies? How does it differ from other roles where you're advising sponsors, if at all, and what is the technical expertise needed?
Sure. I'd say the main difference between regular way M&A and private capital advisory is the fund overlay. We need to understand valuation from a bottoms up perspective at the company level, but you also have to understand how that works in the broader fund structure and what the motivations of a sponsor may be and their underlying LPs are. And so we think about value at the company level and how that rolls up through a fund waterfall. And so that's probably the biggest difference as you think about our kind of modeling process is you're taking the company model, you're rolling it into a waterfall structure. So the management fees have to get paid, the carried interest gets paid based on the performance of the company, and all of that has to go into the math to determine what the net return will be to the secondary investor. And depending on the deal, depending on the type of company, depending on the number of companies, the secondary investors will think about that risk spectrum differently and what type of return they need to acquire that risk. And so, for example, a single asset deal has private equity LBO type cost of capital. They're expecting to make 20% plus IRR, 2 times plus on their money. When you add multiple companies at the same time, that provides diversification. And the diversification starts to look a little bit more like an LP deal that the secondary market started off doing. So they actually like that a lot. That means that they can write larger checks, they can invest more into those deals, and they can typically underwrite it to a slightly lower cost of capital because diversification means that there shouldn't be as much risk. So from an analyst perspective, you think about our junior team out there, there's an underwriting, first of all, there's valuation at the company level, there's also the fund overlay. So what do? Our clients are private equity sponsors, almost always. And so we're hired, let's just keep it simple with the single asset, to do a single asset continuation fund. Well, we talk to them about valuation, where we think valuation will come out. If they think that that works, that's interesting, we'll go out and run what looks like an M&A process. We go out and solicit interest from buyers, the secondary investor universe. They will submit bids, just like M&A. We will move forward one or more of those parties to finalize confirmatory diligence. As part of that, again, the fund overlay, they need to negotiate the documentation and the terms of this special purpose vehicle, of this continuation fund, the management fee, the carried interest that we were talking about, the duration of that vehicle, the rights that they have as investors in that vehicle, and so forth. As we do that, we can start to finalize the deal and then provide the LPs the option to sell or not to sell. Private capital advisory is part M&A and part fundraising, right? We need to go out and raise all the money to buy out the asset into this new fund.
Quick question. Are they often doing a dividend recap at the same time as the sale into the continuation fund? Just because part of the reason you're getting these higher returns is you're buying something and it's primarily funded with debt. Debt is cheaper than equity, so it's like you get those levered returns. And usually, right, over say 4 or 5 years, you have paid down the debt. So in theory, there should be that excess debt capacity. And I assume an investor is potentially going to think to themselves, well, if I'm investing my money, I want to have it so that it's also levered. Like that's kind of the point. So are you often doing that dividend recap at the same time? Or are they raising not just the equity investments? Is there any debt that's happening?
We see it done a couple different ways. There certainly are instances where there's a recap done before the deal. Many times the refi is actually done at the same time as our deal. So we're resetting the clock for this investment by moving it to the continuation fund. And so the sponsor generally wants to make sure that the leverage package can support the growth going forward. And so when you had companies that have really attractive debt packages, this transaction is generally structured as a transfer to an affiliate because, again, the sponsor continues to manage the company. And so depending if you have additional duration, additional capacity, it may be advantageous to leave the existing package in place. And you can do that. That's a big benefit of this technology. But maybe the company's grown so much that the implied leverage has come down, but you want to continue to fund growth. And so as part of the transaction, you can refinance the capital structure to set up that package to align with the duration and the growth plan for the company in the continuation fund. So again, we see it sometimes as a dividend recap before the transaction. Many times it's concurrent with the transaction to set up the future growth. And maybe in fewer instances, it's done after the deal. So again, you're starting this new chapter all on the same footing.
Got it. Okay, thank you.
How do you see the secondaries market continuing to evolve over the next few months and years, given the expected path of interest rates, kind of overall equity valuations where they are now, and changing investor risk appetites? We've had a lot of conversations about the portfolio rebalancing that's kind of continuously happening for these LPs with their allocation towards the equity side of their portfolio and the private equity side and venture capital side having taken on such a huge proportion of their overall portfolio. I'm curious, and again, I know nobody has a crystal ball, but what do you expect to see?
So I think the good news for our market is that it operates well in times of distress and it operates well in times of wild success. Because whether it's a GP that's driven by LPs knocking on their door saying, hey, we need liquidity, or it's the single asset example of we've got this great asset we want to hold on to, right? The technology applies all across that spectrum. So I think that supports continued growth in this industry because there's only so many sponsors that have actually, most of the large sponsors have actually done at least one deal, but there's still a whole universe of white space that hasn't done anything yet. So that's an area of growth. And then you have the sponsors that have done something before and will continue to programmatically and strategically access this market. So I think that's one thing. I think the other piece from the secondary investing standpoint perspective is that, number one, private markets over long periods of time have continued to outperform public markets. That will help the market.
Yeah, which makes sense, by the way, because there is the sort of illiquidity premium. So that's kind of like the textbook takeaway that you would learn in school, is that you should be getting an extra return for that illiquidity. Although it's funny because now it's like there is the extra liquidity in the private space. But
if you look at and we deal with a ton of different sponsors, in most of their pitch materials of pitching their fund, what they'll show you is they hold their assets on their books relatively conservatively. They look at comps, they look at DCF, they look at all these different things, and then they take that illiquidity discount that you're talking about.
Yeah.
When they ultimately sell a company, they have a pop, right? Mm-hmm. So if they're holding it at 100, they sell it for 120, right? They sell it for 130. And so you'll see, if you look at the private equity sponsors' pitch books, at any given point in time, over long periods of time, they sell at 20, 30, 40% pops versus
which kind of makes sense because I'm assuming they're probably marking it at fair value. But then there's, again, like you sell, there is the control premium that you expect to get if you sell a business. So it kind of makes sense that that's also the case as well.
Yeah, I think it's partially LP expectation management. Mm-hmm. Right? The last thing you want
to that's also
LP is worth 100 and then sell it for 85.
Yeah.
As well as like surprise to the upside. But I guess in terms of like the continued maturation of the market, one of the things that I mentioned earlier is, for example, the credit market within secondaries has grown a ton. Or you have groups like Ares getting into the business, Apollo getting into the business, Pantheon's been in the business for a long time. More creative, flexible pools of capital, strategic, like more hedge fundy type group, like Atalaya is in the business. There's a group called Cross Ocean that's in the business. So all of these pools of capital noticing that they can solve this liquidity problem, whether that's in the LBO buyout market, growth equity, venture, credit, infra. So the pools of capital continue to form. I think the big change in the market is as we start to see the realized performance, right, of single asset continuation funds and the multi-asset continuation funds, that will allow the secondary investors to actually point to a track record and say, look, this is what we've been telling you. You've trusted us, but now it's time to kind of go all in and continue the strategy. And hopefully that helps solve this undercapitalization issue where the quantity and quality of sponsors that are looking to do something like this is not the challenge here. It's how do we align the pool of capital to match the opportunity. And that's been the issue for some time. And hopefully that starts to change over time and start to resolve itself. And this market can grow multiples in the next 3, 4, 5 years. I wouldn't be surprised if we're $300, $400, $500 billion market versus 120, 130.
This is so interesting. I actually feel like I want to kind of go back as a college kid and like go into secondaries because this is actually like super fascinating. So speaking about getting into the field, what is the path for young people who want a career in secondaries? What does recruiting look like? Are you hiring straight out of undergrad, or do you want people to have worked in, say, sponsors for 2 years? Do you want people to have M&A experience? What are, I guess, the traditional roles or paths to getting into this particular space?
Yeah, I think the good news is that we certainly do hire direct out of school. It's where almost, I would say, for our group, historically, a lot, if not, almost all of our hiring, where we've been most successful. And so we have a large internship program. Our team at Evercore is 100 plus people, right? So it's a big group. It's a growing group. We've got a ton of market share where your experience on the ground day to day, you're learning a ton. And so we prefer to hire out of school, have people actually roll up their sleeves and work hard and learn a bunch. So internship program, analyst program, that's where folks can certainly get their foot in the door. And we do lateral hiring, we do hiring from M&A as well, we do hiring from private equity. When I started doing this, no one knew what secondaries were, like, period. And now I have friends that have actually come into the industry after working in private equity because of their growth in this market.
I love that. It's like the exit from private equity is secondaries, which was Jen, like, I feel like she's like, what do we call, like, regular private equity roles? Do we call them primaries? I'm crediting that.
Yeah, no, but I'm serious. We don't have the vocabulary. This is an actual question I had. You're talking about PE secondaries. What do you call the original LBO? PE primary? How do you reference it? I'm actually curious.
Yeah, so the fund investment that we're talking about, the pension fund says, oh, there's a new Blackstone or fill in the blank sponsor fund that I'm going to commit to for 10 plus years. That is generally considered the primary investment.
It is primary. See, I was right.
And for people who want to start their career here, do you see a lot of interest from the private equity firms trying to recruit people? Because again, I feel like everyone thinks that they want private equity, which is why I think it's hilarious that you have people from private equity be like, I'm coming back in. But do you see that there is a good path for someone who says, hey, I really want the kind of traditional private equity experience? Do you see people coming into secondaries for a couple of years, going to private equity after? Is that a good path for someone who's interested?
We certainly do see it happen. I think what I would say is more developed as just like the path is, secondaries itself is private equity. You're an investor in these funds, in these assets. And so it's a different, but it's certainly similar. So we're starting to see that path become more developed. Probably a not impossible, but tougher leap to say, I'm going to go work at a buyout fund and go work at Blackstone, for example, versus Blackstone Strategic Partners, their secondaries fund, which the experience is just more relevant. Because you're working on the same types of transactions, you understand the nuance, you understand the underwriting, the work day in and day out.
I have one last question for you. So we've talked a lot with various people from all across the spectrum of the industry about what the lifestyle is like on a day-to-day basis. You're a young dad with a couple of children, and I'm curious to understand how you navigate that and how you navigate being a father with young kids while you're in a role like this, what your hours are like, what you find your work-life balance to be, and where the pain points are and where you think the real value is.
I think as you grow up in the business, your work-life balance should get a little bit better along the way, right? Every year it gets a little bit better. You become more efficient, people trust you more, you have a little bit more freedom in what you do. So as an analyst in our group, or as when I was an analyst, which feels like not that long ago, but now a decade ago, you're working really long hours, 75, 85, 95 hours a week, depending on the week. It's brutal, right? It's definitely brutal. I remember when I started dating my wife, I would run out and grab drinks, and I would come back to work, right? Because we had desktops at that point. Like we weren't even on a laptop. But you come in, you work hard, you prove yourself. I think part of it is on you as the analyst to say, hey, I am trusted. I have worked hard. My team does know that I'm going to do XYZ task. I'm going to go and meet my parents for dinner because they're in town visiting. I'm going to go to the gym because ultimately no one's going to go and tell you to do that. But if you've proven yourself, you've worked hard and you have the trust, and you say, I need to just go run out and do X, Y, and Z, but I'll be back and I'm going to get this to you tonight. If you're on a good team, that will always be available to you, but you have to be the one to take it upon yourself and raise your hand for that. So I think that's kind of what I've been successful at doing along the way. Work hard, prove yourself, do a really good job, and then use that to your advantage where in a smart way, when it makes sense, you can do the things that you want to do when you want to do them. And so every year you get a little bit more efficient, you get a little bit more responsibility, you have a team that's under you. And so for me personally, I have 2 young boys at home, a third boy on the way in less than 3 months. So it's pure chaos. Now we're in the office 3 days a week. That's life-changing.
Wow.
That's amazing that that's stuck.
It's stuck for our team. Yeah, obviously there's very public examples of that not sticking, but I think it's a huge selling point for our group. And granted, Mondays and Fridays, there's many times that I end up working more because you don't have to do the commute and I'm plugged in earlier and later. But the freedom to run downstairs and grab lunch and sit down with my kid because I have 15 minutes in between calls, like that's life-changing. So it gets better and better over time, and I think partially it's on you to make it work for yourself because there's always work to be done. Always.
Yeah.
Justin, I have one last question along this line. You actually were introduced to us by one of your former mentees who spoke about you so glowingly and was like, this is the guy who like got me into the industry, who made my career possible. And I'm curious, how do you approach mentorship for young people? You say it doesn't feel like that long ago that your analyst years are in the rearview mirror, but how do you specifically approach mentorship and what do you do to build that kind of loyalty? We've been talking a lot about mentorship lately from the female aspect. Some of our best mentors happen to be male. We've discussed this at length. I'm curious, what do you think makes a good mentor?
The advice that I give, and it's been proven because this was my experience, is you have to figure out not what you know you want to do, because you might not know you want to do it forever, but what you think at that point in time sounds interesting and you think you're going to learn, right? So through my internship experience, I liked certain things about private wealth management. I didn't like certain things. Sales and trading, same thing, right? So along the way, you kind of take pieces. And I think my biggest piece of advice to people is like, you need to be able to be mature enough to look yourself in the mirror and say, do I like this? Do I like the people I'm working with? Am I curious with what I'm learning? Do I think there's opportunity for growth? And you need to be able to just give yourself the honest answer. Because if the answer is no, you can only fake it for so long. And so it will eventually come out in the wash and your performance will lag. You're going to be miserable. There's something that's going to be off, and life's too short, right? It's just life is way too short to waste that time. I don't care how much you're getting paid. So being able to go through, learn things along the way, and look yourself in the mirror, that I think is the biggest piece. And then secondary specific kind of recruiting and mentoring, a lot of that is just education, right? Like when I spoke to John, the guy that you're talking about, and who happens to be an Emory basketball player, which was a good connection, he knew very little about secondary. So I think as people learn about the industry, they actually get quite excited about it, which helps, right? Because it makes my job easier.
Yeah.
But your job goes from being in the weeds to having to pitch and effectively sell, right? As a banker, and you become effectively sales. And so we've had to tell that story many times at a very basic level, say, this is the art of the possible. This is what you can do. And that education process is exactly the conversation, believe it or not, whether I'm talking to college students or a podcast, it's actually the same conversation, because if you don't have experience, you don't know that this is even possible.
I was going to say, I feel like there's also probably some of the like educating the LPs, right, about what this whole thing is, because they haven't heard of it and they need to buy in. They need to understand it.
And they need to make sure they're not being taken advantage of, right? Because that would be my first thing. I'd be like, oh, what's in it for me? Like, what are you trying to get at here, right? Like, this sounds fishy.
Was the initial reaction ultimately at the beginning is, I don't usually have to make a decision like this on one company or multiple companies. I usually send my checks in, I get my checks back, I invest in the next fund. Like, that is what I'm set up to do. And so a lot of our education process, and the reason that the LP side of our business, where those LPs are our clients, is so important, because we can do that education and say, this is why it's actually a win-win, right? The win for the GP, it's really a win-win-win. A win for the sponsor, it's a win for the underlying LPs, and it's a win for the new investors coming in, getting exposure to attractive assets.
Awesome.
No,
Justin, this was fabulous. Thank you so much for sharing your insight and your wisdom with us. Congratulations on your on your expanding family. I know, that's amazing.
I'm warning you. 1 kid is 1, 2 kids is 10, 3 kids is like 10,000, a flying monkey, a circus, but it's the best thing in the whole world. And congratulations to you and to your wife.
Thank you.
We'll talk to you soon.
Sounds good. Thanks for having me.